Imagine pulling in like over $16 billion in just 90 days.
Oh, yeah.
Right. And then you turn around and tell Wall Street, actually, we lost money.
It's wild.
You'd think corporate earnings reports are supposed to be these, straightforward ledgers, money in, money out, just like checking your bank balance.
Right, but it's never that simple.
No, not at all. Because when you step into the world of big pharma, that simple ledger turns into this massive multi-billion-dollar chess game.
A very high-stakes chess game, yeah?
Exactly. And half the pieces are invisible. The players are making these incredibly aggressive moves for a board that won't even, exist until the 2030s.
That framing really gets right to the heart of what we're analyzing today.
Yeah.
Because if you only read the top-line headlines of these corporate releases, you're just completely missing the underlying strategy.
Totally missing it.
I mean, what we're looking at is an unprecedented corporate transformation, but it's disguised as a standard quarterly update.
Right. And our mission today, for you listening, is to really cut straight through that dense financial and medical jargon.
We have to.
Yeah, we're pulling our insights directly from Merck's first quarter 2026 sales and earnings presentation and the accompanying press release from April 30th, 2026.
And we're not just going to sit here and read a list of revenue numbers.
Oh, please, no, nobody wants that.
Right. We are going to connect the dots.
Yeah.
These seemingly disconnected dots of complex drug trials, sweeping corporate acquisitions, and some highly unusual financial paradoxes.
Yeah, the goal is to show you exactly how a pharmaceutical giant attempts to secure its survival for the next decade.
And survival really is the key word there.
Yeah.
Because the fundamental reality of the pharmaceutical industry is that your biggest financial successes today are inherently your biggest future liabilities.
Oh, interesting. Because of the patents.
Exactly. Patents eventually expire. Competitors adapt their science. I mean, you just cannot stand still in this industry.
You have to keep moving.
You have to constantly be buying or building the architecture of your future.
Okay, let's unpack this. Let's jump right into that financial paradox. Because to understand Merck's future, we really have to start with this glaring contradiction in their current bank account.
Let's do it.
So first quarter of 2026, Merck's worldwide sales were a staggering $16.3 billion.
Which is huge.
It's massive. That represents a 5% increase from the previous year. They are bringing in billions. Yet, when you look at their GAAP earnings, they reported a loss of $1.72 per share.
Correct. Which translates to a net operational loss of over $4.2 billion for the quarter.
I need to stop and look at the accounting here.
Yeah.
Because on the surface, making $16 billion and reporting a $4.2 billion loss sounds like a catastrophic failure.
It sounds like the company is falling apart.
Right. But the report details a $9 billion charge, which is that $3.62 per share, solely for the acquisition of Cidara Therapeutics. And they're prepping for another $5.8 billion charge in May to acquire Terns Pharmaceuticals.
Yeah, they're busy.
So it's not like they're just bleeding cash. It feels more like a farmer taking all the profits from this year's harvest just to buy thousands of pounds of new seeds for the winter.
That's a great way to look at it.
They look broke on paper, but they're basically guaranteeing next season's yield. But I have to ask, is this check writing just a sign of underlying panic about their current lineup? Or is it just the cost of doing business in biotech?
I mean, the farmer analogy is spot on. Especially when you understand how GAAP works.
Generally accepted accounting principles.
Exactly. When a pharma company buys another biotech firm specifically for their in-development science, GAAP rules often force them to take that expense immediately.
Oh, they have to take the hit right away.
Yeah, as an acquired in-process research and development charge. You can't slowly amortize the cost of a drug that hasn't even been approved yet.
Because if the trials fail...
Right, if the clinical trials fail, that asset has zero alternative use. So they take the massive hit up front.
Wow, okay.
So it's not an operational loss where they can't sell their existing inventory,
Yeah.
It's aggressive, science-driven business development.
So they're essentially acquiring the companies that have already survived the initial highly risky groundwork.
Precisely. I mean, developing a therapeutic from scratch in-house, that can take a full decade and billions of dollars.
And the failure rate is huge.
Incredibly high statistical chance of failure. So by acquiring companies like Cidara and Terns, Merck is effectively buying a time machine.
A time machine. I like that.
Yeah, they acquire these clinical stage assets, skip the earliest phases of trial and error, and just utilize their enormous global infrastructure to push these drugs across the finish line.
Okay, so if the farmer is buying seeds to replace the current crop, we need to look at the crop they're so worried about eventually losing.
Yes, we do.
Because the core reason Merck is spending roughly $15 billion to buy new companies is to prepare for the inevitable future when they lose their crown jewel.
And that jewel is KEYTRUDA.
KEYTRUDA. Sales hit $8 billion just for this quarter.
In 90 days.
$8 billion in 90 days. Depending on how you calculate the exchange rates, that's like an 8 to 12% growth. It is essentially a skeleton key for the immune system.
Calling it a skeleton key is actually a really great way to visualize the mechanism.
Yeah.
Yeah, because KEYTRUDA is an immunotherapy. Specifically, it works by blocking a pathway called PD-1.
Okay.
Cancer cells often use this pathway to basically hide from the body's immune system. They put up a do not eat me sign.
Ah, okay. Sneaky.
Very. But KEYTRUDA strips that sign away. It takes the brakes off the patient's own T cells so they can actually recognize and attack the tumors.
Wow.
And what's fascinating here is how the drug continues to evolve to maintain its market dominance.
Right, because the sources show they're aggressively moving it into earlier stage cancers, right? They're not just using it as a last resort anymore.
Yes, exactly. Initially, KEYTRUDA made its really profound mark in metastatic cancers.
Late stage stuff.
Yeah, late stage advanced disease where options were just extremely limited. But the strategy has definitely shifted toward intervening much earlier.
Yeah, the data in the presentation highlights this Keynote B15 trial for muscle-invasive bladder cancer.
That's a huge one.
Yeah, when KEYTRUDA was used in combination with another drug, enfortumab vedotin, before and after surgery, it showed a 47% reduction in event-free survival events.
Which is incredible.
Let's clarify that jargon for the listener, though. Event-free survival, or EFS, that's a highly technical way of saying the patient survived without the cancer returning, getting worse, or causing severe new complications.
Right.
And they also saw a 35% reduction in the overall risk of death compared to standard chemotherapy.
I mean, that changes the entire treatment paradigm.
It has to, right?
If you can treat a patient earlier and actually prevent the cancer from returning post-surgery, you are vastly improving medical outcomes. And from a business perspective, exponentially expanding your eligible patient pool.
But there is a defensive twist here, isn't there? Because KEYTRUDA isn't going to have patent protection forever.
No, it is not.
So, this quarter, Merck officially launched something called KEYTRUDA QX.
Yes.
This is a subcutaneous injection version, so a quick shot under the skin rather than a long, drawn-out 5E infusion at a hospital.
Much more convenient.
And it already pulled in $128 million this quarter. But, okay, I have to challenge this a bit.
Go ahead.
Looking at this from a business perspective, it's brilliant. Like the iPhone of the oncology world, an upgrade everyone wants. But medically speaking, is QLEX a genuinely new therapeutic breakthrough? Or is this simply Merck playing defense, extending their patents before chipper generic IV drips hit the market?
Well, what's fascinating here is that it's absolutely a dual-purpose strategy. If we look strictly at the patient experience, transitioning from an IV infusion, which requires scheduling clinical time, sitting in a chair for an hour, dealing with intravenous lines.
It's exhausting.
It is. Transitioning from that to a subcutaneous injection that takes just a few minutes. That is a profound quality of life improvement.
Sure.
The Phase 2 trials evaluated patient-reported preference, and patients overwhelmingly prefer the quick injection.
I mean, that makes total sense. Nobody wants to sit in an infusion clinic if they don't have to.
Exactly. But strategically, you are entirely correct.
I knew it.
This is brilliant defensive maneuvering. By transitioning the market to the QLEX injection now, Merck is setting a completely new standard of care.
Before the patents expire.
Right. So when KEYTRUDA's original patents do expire and cheaper generic versions, they're known as biosimilars in this space.
Right. Biosimilars.
When those enter the market, those early competitors will almost certainly be restricted to the older 5E formulations.
Oh.
Yeah. Merck is betting that oncologists and patients will be so accustomed to the convenience of the shot that they'll refuse to switch back to an IV.
Even if the IV is significantly cheaper.
Exactly. It builds a massive moat around their market share.
It's like the classic razor and blades model, but applied to life-saving oncology.
Pretty much.
So if KEYTRUDA is the present engine funding all of this future strategy, let's look at the new drugs taking the baton.
Yes, the rising stars.
Because we need to talk about these rising stars versus the struggling legacy products. No single drug can carry a balance sheet indefinitely.
True.
Let's start with their cardiometabolic and respiratory division. A drug called Winrevair saw an 88% growth rate.
Massive growth.
It brought in $525 million this quarter alone, with over 29,500 total prescriptions. And then another one, OH2Vair, brought in another $131 million.
Yeah, so Winrevair is a critical piece of this generational transition. It targets pulmonary arterial hypertension. It's a rare progressive disorder where the blood vessels in the lungs thicken and narrow, which puts just immense strain on the heart.
Oh, wow.
Historically, treatments just tried to dilate those blood vessels to relieve the pressure. But Winrevair actually targets the underlying cellular signaling that causes the vessels to thicken in the first place.
So it's getting to the root cause.
Exactly. And the launch uptake in the U.S. and early international markets like Japan and Europe, it just demonstrates a substantial unmet need for this specific mechanism.
I see the success there. But when I look at the rest of the balance sheet, one of Merck's most famous legacy products is taking a really noticeable hit.
Gardasil.
Yeah, the Gardasil vaccine franchise, the foundational HPV vaccine, it saw a 22% drop in sales down to $1.1 billion.
Right.
The earnings report attributes this to lower demand in China and Japan following national catch-up programs. But my question is, can a highly specialized cardiovascular treatment like Winrevair realistically offset a 22% drop in a globally recognized vaccine like Gardasil?
It's a vital question. And it really gets at the mechanics of pharmaceutical life cycles.
Yeah.
The short answer is that Winrevair doesn't have to carry that weight alone. What we are seeing with Gardasil is actually a textbook example of demographic normalization.
Demographic normalization. How does that actually work in practice?
Okay, so when countries like China and Japan run these comprehensive national public health campaigns to immunize their populations against HPV, you see an enormous artificial spike in sales.
Because everyone is getting it at once.
Right. Millions of people outside the traditional age window are getting vaccinated all at the same time. But once that broad population is caught up, demand naturally valleys.
Oh, I get it. Because then you return to just vaccinating the new incoming cohort of younger adolescents each year.
Exactly. It's a completely predictable demographic cliff.
So the underlying demand hasn't vanished at all. The backlog has just been cleared.
Exactly. And to address the revenue replacement aspect, you also have to look at their newer pneumococcal vaccine, VAKVE. That one is up 31% to $142 million. Merck's stated strategy isn't to find a single one-to-one replacement for Gardasil or KEYTRUDA.
It's a team effort.
Yeah. In their presentation, they explicitly outline a plan to launch over 20 new growth drivers.
20?
Yeah, they're aiming for a $70 billion commercial opportunity from these new assets combined by the mid-2030s. They don't need one new Gardasil. They need 20 distinct, highly effective drugs operating in tandem.
Building a diversified wall of revenue.
Precisely.
It is the ultimate portfolio diversification, which brings us to the actual science they are buying to build that $70 billion wall.
A pipeline of tomorrow.
Exactly. Let's look at that pipeline. Remember that $5.8 billion Terns Pharmaceuticals acquisition we discussed earlier?
The transaction expected to close in May, yes.
Yeah, they are executing that acquisition specifically for a drug candidate called Terns 701.
Right.
The report describes it as a next-generation allosteric TKI for chronic myeloid leukemia, or CML. Let's unpack that, because throwing around terms like allosteric TKI is a great way to lose a listener.
It's a mouthful for sure.
What exactly is a TKI, and why is the word allosteric so important here?
Well, it's actually a brilliant bit of biochemistry.
Yeah.
So TKI stands for tyrosine kinase inhibitor.
Okay.
In chronic myeloid leukemia, the cancer cells produce this abnormal enzyme, a tyrosine kinase, that just constantly sends a signal telling the cancer cells to multiply.
Like a broken off switch.
Exactly. So a TKI is a drug designed to bind to that enzyme and force the off switch. But historically, these drugs bind to the active site of the enzyme. They basically walk right through the front door to shut it down.
But the cancer mutates, right?
Precisely. Over time, the cancer mutates the shape of that active site. The front door lock gets changed.
Oh, wow.
And suddenly, the original TKI drugs can no longer get inside to turn off the signal. And this is where allosteric comes in.
Okay, what does that do?
An allosteric inhibitor doesn't try to go through the front door. It binds to a completely different location on the enzyme. Think of it as finding a hidden side window.
I see.
When it binds to that side window, it actually forces the entire enzyme to change shape. It shuts it down from the outside.
That is wild.
For a patient who has developed resistance to standard treatments, an allosteric TKI offers a completely new lease on life.
That is just a phenomenal piece of engineering.
It really is.
And we see a similar theme of managing long-term resistance in their infectious disease pipeline, too.
Yes, with HIV.
Right. They highlighted the FDA approval for IDVYNSO. This is a once-daily oral 2-drug regimen for adults with virologically suppressed HIV-1.
Yo.
But the report specifically notes that IDVYNSO is notable because it does not contain an HIV integrase strand inhibitor.
Right.
Here's where it gets really interesting, because normally you brag about what's in the drug. Why is taking a specific ingredient out considered such a triumph that it gets front-page placement? I mean, we've gone from treating HIV like an immediate emergency sprint to managing it like a lifelong marathon, right?
That marathon analogy is exactly it. We have to look at how HIV treatment has evolved over the years.
Okay.
In the early days, the focus was purely on immediate survival, stopping the virus by any means necessary. And integrase inhibitors are incredibly powerful tools for that.
How do they work?
They work by blocking the virus from inserting its viral DNA into the host cell's DNA.
Oh, okay. Pretty fundamental.
Very. But today, the expectation is that an HIV patient will live a long, natural lifespan, which means they're going to be taking these medications every day for 3 or 4 decades.
And taking any medication for 40 years is going to have compounding effects.
Exactly. Prolonged use of integrase inhibitors has been linked in some patients to weight gain, metabolic syndrome, and just other long-term side effects.
That sounds rough.
And furthermore, the virus can eventually mutate and develop resistance to that specific class of drugs.
Just like the leukemia we were talking about.
Yes. So by developing IDVYNSO without an integrase inhibitor, by utilizing different mechanisms to prevent the virus from replicating, Merck is basically providing a vital safety valve.
Giving them options.
Right. It gives physicians a highly effective tool to rotate a patient's regimen, giving their body a break from the metabolic toll of integrase inhibitors while still preventing the virus from developing multi-class resistance.
They are treating the side effects of the cure just as seriously as the disease itself.
Exactly. Quality of life care.
And we see that focus on removing barriers to care in their cardiovascular pipeline as well. They presented phase 3 results for enlicitide.
Yes, the oral cholesterol medication.
Yeah, and the clinical numbers were just remarkable, showing reductions in LDL cholesterol, the bad cholesterol, up to 64.6%.
Those numbers are vital because they mirror the kind of dramatic cholesterol reduction historically only seen with injectable therapies.
Injectable.
Specifically, PCSK9 inhibitors. PCSK9 is this protein that degrades the receptors on your liver that cleared bad cholesterol from your blood.
Okay.
So by inhibiting that protein, you free up your liver to clear out massive amounts of LDL.
But normally you have to take a shot for that.
Right. So achieving that level of clearance in an oral pill, rather than requiring patients to inject themselves, it drastically improves patient compliance.
Oh, for sure. People hate needles.
Exactly. If a treatment is easier to tolerate, patients stick with it, and long-term cardiovascular events decrease.
It all circles back to making the science accessible and durable.
It really does.
Now, while Wall Street analysts focus heavily on, human oncology and next-generation gene therapies,
Right.
there is a quiet $1.8 billion giant sitting right in the middle of this earnings report that we absolutely cannot ignore.
Oh, the Animal Health Division.
Yes, their animal health division generated $1.8 billion this quarter.
Unbelievable.
That represents a 13% growth rate. It is driven by both livestock, meaning poultry, and cattle and companion animals, like dogs and cats.
Right.
Specifically, they highlight Bravecto, their flea and tick medication, which hit $379 million alone.
Wow.
And the FDA just approved Numelvi, which is the first second-generation JK inhibitor for allergic dermatitis.
Right, which is essentially severe chronic itching in dogs.
Yeah. I have to admit, seeing $1.8 billion generated in just 3 months on animal care is staggering to me.
It is a lot of money.
In a tightening economy. People might skip a personal vacation, but they apparently will not hesitate to buy premium targeted JAK inhibitors so their dog stops scratching.
I mean, it sounds amusing, but if we connect this to the bigger picture,
Okay.
it explains exactly why pharmaceutical conglomerates value a robust animal health division so highly.
Why is that?
It acts as the ultimate economic buffer.
A buffer against the volatility of the human healthcare market.
Exactly. Think about the friction inherent in human therapeutics.
Yeah.
You have to negotiate pricing with massive government entities like Medicare.
Right.
You have to navigate the pricing pressures of new legislation, like the Inflation Reduction Act. You're constantly battling with private health insurance companies, pharmacy benefit managers.
Just constant red tape.
Constant. But the animal health market bypasses almost all of that.
Wait, really?
Yeah. Animal health is largely an out-of-pocket cash pay market.
Oh.
When you take your dog to the vet for allergic dermatitis, you aren't waiting 3 weeks for a prior authorization from an insurance conglomerate.
No, you just pay the veterinarian directly at the counter.
Exactly.
Okay.
Furthermore, consumer behavior shows that people treat their pets as direct family members.
That's very true.
The demand is incredibly price inelastic. Even during an economic downturn, consumers will cut back on their own luxuries long before they allow a pet to suffer.
So it provides this foundation of just predictable, unregulated cash flow. The flea and tick medication is indirectly providing the financial stability needed to fund the high-risk leukemia research.
It is all part of a carefully balanced financial ecosystem.
Yeah.
The predictable cash from Brevecto smooths out the volatile billion-dollar risks taken in the oncology labs.
That is just brilliant business design. So what does this all mean for you as you evaluate this landscape?
It's a lot to take in.
Let's bring all these threads together. When you look at the entirety of this first quarter report, the $8 billion in KEYTRUDA sales, the strategic defensive upgrades to subcutaneous delivery.
The QLEX launch, yeah.
Exactly. And the $15 billion allocated for acquisitions between Cidara and Terns, plus the quiet, steady powerhouse of animal health.
Right.
A very clear narrative emerges. Merck is leaning aggressively into its identity as a buyer.
Absolutely.
They are utilizing the monumental cash flow generated today to engineer their way out of future patent expirations by acquiring the breakthrough science of the 2030s.
And this raises a profound question, something for you to ponder long after we wrap up this analysis.
Let's hear it.
It isn't explicitly stated in the financial tables, but it is the silent current running beneath every single one of these acquisitions.
Okay.
If legacy pharmaceutical giants are increasingly buying their most promising pipeline drugs from smaller, nimble biotech startups companies like Cidara, Terns, and others,
Yeah.
are we witnessing the slow decline of in-house corporate R&D? Has the traditional big pharma model permanently shifted from being a laboratory filled with scientists discovering miracles to becoming a giant, well-funded venture capital firm that simply acquires the best science once it's already been proven?
Wow. That is a fascinating dynamic to consider. Are these institutions drug makers, or have they evolved into drug buyers?
The rules of the board are definitely changing.
They really are. Well, we want to thank you for joining us on this deep dive into Merck's Q1 2026 earnings. Keep questioning the logic behind the numbers, keep looking for the invisible strategies driving the market, and we will catch you next time.